Mihir Vora, Director and Chief Investment Officer at Max Life Insurance. He's joining us in the studio. Good to have you in the studio with us, Mihir. Vitals of the market in terms of earnings. Start has been okay. It's not like a big bang start to the earnings season. Macro environment also sluggish, weak, the data, the points that we've been getting. Any bright spots that you can pick out on?
The biggest bright spot is that finally it looks like the government and the regulators are coming around to the fact that there is a slowdown. So we've seen the central bank, the RBI, distinctly turning dovish in the last few months. And we had the big bang corporate tax cut by the government. My guess is that if this slowdown continues, you can see some more dramatic big bang reforms. So my guess is there's a significant policy upside with good liquidity conditions that can be the driver for the market.
The overall sentiment, though, in terms of spending, private sector savings have gone down. Capex, for that matter, is not going to pick up because the government is looking to scale back a bit because of the fiscal deficit numbers that could be challenged now. You feel that all of this will take a lot of time to actually play up and play out in a positive way?
Yes, the private sector manufacturing capex may take a bit of time, especially the domestic corporates, because I think they're still more circumspect. But the FDI flows can really pick up in the next 24 months, because we must remember that there's a finite window by which the FDI has to come in to avail of the tax benefits. So next 2 years should see a lot of companies coming in to take advantage of the 15% corporate tax rate, not only the private sector but the FDI also. So my guess is that in the next 2 to 3 quarters we should start seeing the capital goods order book start building up, and it will be a mix of FDI as well as local demand. On the other hand, we need to fix the real estate problem, because that's where a lot of capital is stuck, investors' money is stuck, customers' money is stuck, and the builders and the NBFC crisis is kind of a function of that. My guess is, again, I think things are coming to a head with all the headlines that we are seeing, both for banks as well as for NBFCs. In the next few months, if we get some kind of a decisive policy, maybe tax break or whatever incentives for the real estate segment, then that can kickstart the real estate investment cycle also.
Okay.
So, I mean, a lot depends on policy.
A lot depends on policy, yeah, and more so right now. Mihir, would the policy actions bring us out of the slumber that we are in with regards to the non-index or non-Nifty 50 names? Even in the Nifty 50 it's polarized, but I'm just using that as a benchmark.
Sure.
The last time that we saw a prolonged slowdown was November 2010 to about May 2014, but the index just stayed within a very narrow range. The last 2 years we're now starting to see that. Will this extend itself, or do you think it's coming to an end?
The slowdown in the
mid cap and the small cap prices, stock prices.
I think a lot of it is done. We've seen a lot of pain already in the mid and small cap segment. The fact that interest rates are coming off impacts positively the mid and small caps the maximum, because interest costs to PAT is amongst the highest for the smaller companies, and so you have absolute deleveraging happening plus interest rates coming down, and hopefully with order books filling up. Some of the segments are not there in the Nifty. For example, hardly any real estate stocks, hardly any capital goods stocks in Nifty. So
no chemicals,
no chemicals, all that.
So no gas stocks.
Textiles, gas, so all these. So if at all we are going to see any kind of pickup in these FDI export-linked theme, it has to be in the non-Nifty stocks.
Okay, so if you had the mandate and you have the leeway, would you, where within these non-index pockets, themes, would you take an oversized bet on me? Let's assume that the time horizon is not necessarily 6 months, 12 months. Your mandates are anyways higher. Where are you taking this bet?
So the biggest bet, and I think that's a bet not only on the segment but also on the country and the policies that we are going to follow going forward, would be on the capex segment, because job creation, trade deficit reduction, export, these are all the same theme, right? We need to reduce our trade deficit, not only with China, but with the rest of the world. And that has to come from manufacturing, because that's the only segment. Manufacturing and real estate are the two big segments where we can create jobs. And the demographic dividend is running out fast. We only have a probably 15-year window by which we can do these things. So I think we have to do it now.
I just want to come to you on real estate, since we were talking about it. Does one start to focus on companies which have a larger commercial real estate portfolio? Because that's a segment that's really aiding this time around.
So The slowdown is really on the residential space.
Yeah.
The commercial real estate space. Actually, we as an insurance company also.
And with REITs also.
REITs, commercial real estate. We as an insurance company invest directly into real estate also. And as of now, we are sticking to commercial real estate. Good quality real estate in the commercial space are hard to come by. So there is good demand in that space. But the fact is that real estate in the commercial segment is only probably 20% of the overall real estate market. 80% is still the residential segment, and out of that 80%, probably by value, 70% is in the big cities. So this Bombay, Delhi slump that we are seeing is something that needs to be taken care of.
Because affordable housing is doing fine.
Affordable housing is doing fine, exactly. Yeah.
Okay. The other theme that everyone has been looking out for with a hawk's eye, and probably even some have traded it and played it, has been this whole divestment theme from the government. And privatization. Do you feel this has got the legs to move up?
Looks like the government is serious. We've seen the tenders for merchant bankers coming out for a couple of the divestments that we already seen announced in the budget. So I think the fact that things are coming to a head and we are seeing actually negative numbers on IIP is going to kickstart a lot of policy action. And that, as we discussed, the biggest upside from the market can be from the policy, because in terms of the cyclical slowdown, that's not going to stop in a couple of months. It will take its own time. But the fact that globally that's the situation. Globally, if you see the US, the markets are at near all-time highs, but the economy is slowing down. But the hope is that liquidity will keep supporting the financial assets. That's going to be a theme in India also.
Maybe, as one of Mihir's tweets says, that bad news might be good for the markets because you get bad economic news and that drives policy action going ahead. Just wondering, the one pocket where the market seems to be completely at loggerheads is autos. And the data points also suggest completely different. There is one data which suggests it was a really good Navratri, but we talk to dealers and you will get to know that while there were footfalls and conversions, it was not necessarily that gung-ho.
Right.
The aggregate market cap of the sector has also come off. Would you be a buyer here, or would you wait for some concrete data points before taking some large bets?
See, auto is a relatively easy sector to take a call on, because we get monthly data, we get monthly data. So the thing is that as of now, things are still looking slow, but stock prices have come down by 30 to 50%. So to that extent, it's a good idea to start nibbling, because you're not going to catch the bottom. Markets are typically 3 to 6 months ahead of the cycle. And with valuations already having corrected in the good quality names, especially segments like cars and tractors, I don't believe that these segments can remain at negative growth rates for too long. Because that, otherwise the whole demographics, penetration, income level, increasing availability of financing, that theme, I don't think that's going to go away in a hurry.
Obviously, the government didn't do much with regards to GST cuts for the auto industry, but one thing that the market is watching out for, and probably commentary from state governments regarding road tax, if something of that sort comes about, that can also be a significant fillip for the industry.
Yes, but the structural demand has to come from the customer. I mean, he may postpone his decision by a few months based on expectations of GST cut, etc. But that base demand ultimately has to come from the customer, and that's where the whole income level, demographic, increasing financial penetration theme has to go. I mean, you can cut rates and stimulate demand for a couple of months, but that's not sustainable.
But what do you think is the bigger problem then? Because financially, banks are supporting. There is no issue with banks giving EMIs or financing car loans. Liquidity is there in the system. So what is the issue with the demand? Do you feel it's just the big ticket purchases that have transitioned the consumer from spending 4 or 5 lakhs on a car versus maybe even a 1 lakh rupee phone, for that matter?
I think it's a combination of both. But the bigger crux of the problem seems to be the NBFCs moving out of this space. Because probably in the tier 1 towns and cities, you have the big banks readily offering finance. But as you go down in the tier 2, tier 3 cities, it's mostly the NBFCs who are taking care of it. And that has disrupted not only the consumer financing part, but the dealer financing part. So you have seen stories of a lot of dealerships for cars and two-wheelers shutting shop in the last few months. So that's not been a function of, I would say, those dealerships not doing well because of consumer demand. But I think there was somewhere in the system it got short-circuited, where some NBFC withdrew finance from some dealer, and that. The thing is that dealers, again, probably are business people, and they also have their money stuck in real estate. Who knows?
Yeah, well, let's wait and watch. But Mihir, so good having you in our studios for the first time. Pleasure talking to you today. Thanks so much for taking the time out.
Always a pleasure. Thank you so much.